He obviously knows about the inner workings of this agency and, more importantly, about the data that they're dependent on. I don't know what the solution to this, Bill. I know there's a lot of real-time data, if you will, that comes out now that we maybe didn't have in the past. But is there some advantage that Powell and company would have in weighting that a little bit more heavily than the backward-looking data?
I think they do weight the data that's more readily available. I mean, at every FOMC meeting, people report on the contacts that they've had recently with people in the business world. So it's not just the economic relief data from the federal government. There's also a lot of anecdotal data that helps fill out the picture. I think the problem is just one of the fact that to know what to do, you have to know what reality is, and it takes time to translate from economic releases to what's actually happening in the economy. And the data is noisy. It bounces around month to month. It's subject to seasonal adjustment problems. It gets hit by shocks like the weather, the hurricanes, strikes. And so knowing exactly where you are at any particular point in time is very difficult. Another problem the Fed has, frankly, is they also have this fundamental problem of trying to assess the current stance of monetary policy. How restrictive is it? Yeah. They think it's quite restrictive right now, but the economy is continuing to gallop along. The Atlanta Fed raised their GDP now forecast to 3.4% for the current quarter. So that's not an economy that looks like monetary restraint is restraining very much at this point.
Well, that gets to a question, too. And I don't ever want to sort of minimize just how difficult this job is. I mean, we're armchair quarterbacks here, so we always think that we know more than what's going on behind the scenes. But a sort of an undercurrent, though, of the criticism is this idea that the market wants the Fed to maybe be a little bit more articulate or, if not aggressive, in saying where they think the economy is going. And I know we get the dot plots, but they're hungry for something a little bit more. And I'm asking you as to whether you see any value, any true upside on a net basis for Powell to do that.
Well, I think the problem here is that the Fed's crystal ball in terms of economic forecasting is not much better than the crystal ball of everybody else. And you can see that by looking back at the summary of economic projections at other points in time. Those summary of economic projections have been often turned out to be very wrong with the benefit of hindsight. I mean, the Fed did not forecast a big surge in inflation. The Fed was pretty late to raising interest rates this cycle. So I think the Fed's reaction function is pretty clear. There's how would the Fed react to a given set of economic information? The Fed, I think, made that very clear. You can see that in the summary of economic projections. You can tie their economic forecast with what they would actually do in terms of interest rates. Mm-hmm. What isn't very clear is how the economy is actually going to evolve. And it's that uncertainty about the economy that's magnified by the noise in the economic releases themselves that make it very difficult for the Fed to, plot things out more than a meeting or two in the future.
You had said the data is noisy, but being data dependent means relying on each data point. So I feel like the anecdotal becomes more important. It's something that the Fed officials are certainly paying a lot of attention to. Should we be paying more attention to things like the Beige Book?
I think what you want to do is you want to treat the data in its entirety. I always tell people that it's like an impressionist painting. You don't focus on one dot. You focus on the totality of all the dots. Each little piece of economic data represents a dot, and you sort of need to stand back from the painting to really get a sense of what's really going on. So I think the markets at times, overreact to the last piece of economic information, not recognizing that the information that's being released by the governments are just estimates. They're surveys. They're doing a survey, and this is what the survey results come back. Mm-hmm. Just like a political poll survey, plus and minus, errors, survey errors. And it's even worse for the economic news because, the weather changes, economic conditions change, there's strikes, there's all sorts of shocks to the economy that distort the data that's released relative to what's actually happening.
Yeah, there feels like there's a lot of contradictions going on right now in this current economy. You have tight monetary policy even after that supersized cut, but you also have a loosening of financial conditions over the past year. Why do you have this tension here?
Well, financial conditions have loosened a lot because people are anticipating that the Fed is going to cut rates a lot over the next year. So obviously, if the Fed doesn't do that, financial conditions will tighten quite a lot. And we've actually seen a little bit of tightening of financial conditions in terms of the bond market and mortgage rates over the last few weeks, as the market went from expecting short-term interest rates to decline below 3% to now more in the 3.25%, 3.5% range. So right now, the market is where it is in terms of financial conditions because of the expectations that the Fed is going to cut interest rates a lot. If the Fed doesn't do that, then financial conditions will have to adjust.
I am curious, Bill. I do want to just shift gears a little bit here and just kind of talk about what the Fed's job is going to look like when we get to January. We're going to have a new administration one way or another. There's been a lot of discussion about deficits. There's been a lot of discussion about tariffs. There's been a lot of discussion about whether the dollar will weaken or strengthen. These are all things now that Powell is going to have to factor in to his monetary policy decisions beyond just the economic data.
Well, I think the House and Senate are probably going to be very closely divided, so that will restrict the room for maneuver of any incoming president. But I think the one area that I think that's really important from the Fed's perspective is Trump versus Harris on tariffs. Candidate Trump has basically said he wants to do a 10 to 20% across the board tariff plus a 60% tariff on China. This would be far greater than what he did during his first term in office, and I think economists believe that this would be pretty terrible for the economy. It would basically drive up inflation and hold down growth by reducing productivity. Voters don't seem to think that. There was a poll by Reuters in September, which actually had something like 56% of the voters thought that doing what Trump was proposing would be a good thing. I'm an economist. I side with the economists.
Yeah.
There was an interesting a poll by the Booth School, University of Chicago Business School, and they found 95% of economists agreed or strongly agreed with the statement that if Trump did what he wanted to do in terms of his proposals, that this would actually be passed through and result in higher prices for consumers. Mm-hmm. So economists are pretty united on this, and the University of Chicago is not a left-wing institution.
No,
so
no.
This is something. So this is not a left-right kind of issue. Yeah. Economists are pretty united that higher tariffs result in higher prices that consumers in the U.S. would actually have to bear.